This is Professor Hazer again, and this is the fourth video in this problem. The first of one or two problems, the first of two problems on basic consolidations with non-controlling interest. Okay, so I had read the first video. I read to you the problem. In the second video, I did the calculations, which are all up here. And then in the last video, I actually did the consolidation entries, noting that the main four consolidation entries, these four right here, are mostly derived from this simple table right there. So if you can make this table, these entries are pretty repetitive. Now we're going to do the consolidation. And I've already done the entries, so all we've got to do is post them. Okay, so here's our consolidation down here. I'll put the entries in and then post the entries. Okay, in entry 1, we're going to eliminate the income from sub-account, eliminate the subs dividends, and reduce the investment account to its beginning year balance. So this is entry number 1. Notice I put references right here. So the first debit is to income from sub, 60,200. Notice that will eliminate ultimately the subs income, or the subs, the parent's income from sub. It says subs income. Okay, the next entry is going to be a credit to the subs dividends, which is right here. So this is entry number 1 right there. Go ahead and post that right there. Notice what we're doing here is we are eliminating 70%. The sub-paid dividends of 50, we're eliminating 70%. Give you a hint of where we're going with this. Eliminate the other non-controlling interest, 30% right there. Anyway, and then finally, difference between the two, between the 60,200 and the 35,000, is going to go, look at entry number 1, is going to go in as a credit to the investment account. Really, I should say entries number 1, but it'll go in as a credit to the investment account right there. And after we do that, I'm going to do the consolidation, the addition later, just to show you. After we do this entry here, consolidation is now at 490, and that's the beginning balance. And notice that we're going to take that 490 and make it 0 in entry 2. Okay, so in entry 2, we're going to eliminate the common stock for the sub. We're going to eliminate the retained earnings for the sub, the beginning retained earnings, and then we're going to write up these 3 assets to their beginning of year balances. Okay, so the first debit there, I have to go back and forth here, is a debit to common stock. This is entry 2 right there. The common stock entry in entry 2 always goes at the bottom. Assuming this course, the common stock will not change. So we're going to debit common stock for $500,000. Second entry, entry 2, is going to be the subs to the subs beginning retained earnings, because these are all beginning amounts. After all, at 490, the beginning amount. So we're going to debit subs retained earnings for $100,000 on. Okay, next, in entry 2, now we're going to write up a bunch of assets, starting with inventory, I believe. This is go up here. Inventory, buildings, equipment. So in entry 2, we're going to debit inventories. It's going to be entries 2 and 3 there, you can see. Okay, so we're going to do an entry 2. Inventory for 5, that's the amount by which we wrote it up by when we bought the stuff. Also going to debit buildings. Make sure to get the right debit in there to the buildings. But buildings for 14. Somewhere down here, we're going to debit equipment for 21. These are the amounts that, it's a first year consolidation. These are the amounts by which we originally wrote them up. And then finally, we're going to actually create the goodwill. Kind of reminds you of business combinations. We created goodwill. We're going to create goodwill for 60,000. Okay, now what we're going to do is we're going to have 2 credits. One is going to be for 490, which eliminates the beginning investment balance, Then you haven't seen this. This is why I'm doing this, because I think the book got this out of order. They present it, but like 3 chapters from now. This is so basic. I don't know now. Is non-controlling interest. We're going to credit that for 210. Okay, so and I'm going to show you where that goes. The credit to the investment account goes in the investment account. So you'll notice there's really a credit here. It's that 0 right there. That credit right there to the investment account. We'll make it 0 at the end. But we'll make that balance 0 at the end. Don't worry about it now. And the final entry goes to non-controlling interest. Now, you'll notice that all consolidation worksheets, this is why I'm doing this now. Doing it later is like putting the cart before the horse. We're going to credit non-controlling interest for its beginning amount, which is 210. Okay, so there's your beginning non-controlling interest, and that is for 210 right there. Okay, now we go to our expensing entry. This is entry number 3. So in entry number 3, we wrote up inventory by cost of goods sold. It was sold this year. It's a first year consolidation, so $5,000 excess cost of goods sold. And then we had a total of 9 excess depreciation on buildings and 7 on the equipment. Okay, and then got the inventory right there. Okay, so entry number 3, let's start with the 2 expenses. Entry number 3, going to debit cost of goods sold, $5,000, and we're going to debit depreciation expense, $9,000. And then for buildings, we're going to credit basically inventories, buildings, and land. Okay, well, let's start with the inventories part. Inventories part is we're going to credit inventories for entry number 3, $5,000. Notice basically you wrote it down because you sold it all out the door. Now for buildings, we wrote up buildings by 14, and we're going to write off buildings over 7 years, so $2,000. So notice the 14 minus the 2 means that you've got 6 years left at $2,000 per year. And then finally, you've got a credit to equipment for $7,000 right there. Okay, so let's see. So far, our debits are equal to our credits, so we're looking good. Okay, in the 4th entry is to update non-controlling interest. And remember, the ending non-controlling interest, going back to the table here, is $220,800. Beginning was $210. We already have the $210 down here. So what we've got to do is add the extra $10,800, I think it is, to update that at the bottom. That's sort of a balancing total. We can't put 100% of assets on one side and 70% on the other. Okay, so let's go see what we do. Non-controlling interest income, NCI income. I call it NCIS. You can call it NCII. Like non-controlling interest income statement or income, it doesn't matter. Notice it's a debit for $25,800. Okay, and what I'm going to do is, this is entry 4. I'm going to put it right here. And notice that I'm going to put it, your consolidated net income. And you've got to take out the part that's not yours. And we treat it like an expense because it's not yours. So that's kind of like an expense. So that's why we're debiting it. We're going to credit the dividends in number 4. And notice in number 4, what we do is we're going to credit dividends for $15,000. So now we've eliminated an entire 50 for dividends for the subsidiary. It's 50, but minus 35 minus 15. So that's now 0. And notice the plug entry here. Plug entry is to NCI. And what we're going to do is there's a space at the bottom of any consolidation worksheet to let you plug it in. And this plug of $10,800 bring it up to $220,800. So what we're going to do is go down here to the bottom here. You'll notice it says non-controlling interest to 0 now, but we're going to go ahead and have a credit for $10,800. And notice what we've done. It worked through the template there. Notice what we've done is, if you look at those right there, in the consolidated worksheet, I left the addition there, and we started with 210, added 10,800, and on the consolidated worksheet, we're going to have our ending non-controlling interest of 220,800. Okay, now we've got two more entries, which are fairly easy. We've got two reciprocal entries. One is accounts payable. You can't owe yourself $10,000. The other one is dividends payable, dividends receivable. That has nothing to do with retained earnings. It's just you can't owe each other dividends. Okay, so in entry 5, we're going to credit accounts receivable to take $10,000 out of there because you can't owe yourself $10,000. You can't owe yourself. What's going on with this thing? This thing to work here. Okay. I have no idea what this thing is doing here. So anyway, so this will be, so we'll get that out of there. That'll disappear sooner or later. Okay, and this is the easiest part, so I'm going to make sure we get this right here. So this should be equal to credit $10,000. I have no idea why it's doing it. I'm just going to write it in, $10,000. And then that's that number right there from entry 5. I don't know why it's resisting. Okay, so that's $10,000. And wait, I just want to check something out here. Okay, it'll work. Okay, it'll work. So I'm just going to write in $10,000 there. Okay, and it'll work in the end. I have no idea why it's doing that. Okay, and so we have a credit for $10,000 for accounts receivable. We have a debit down here, entry 5, for accounts payable. So we've written off those two amounts. These entries, and I don't know what's doing that. Okay, and then finally, there's an entry that I put in there for dividends receivable, dividends payable. If on the test you missed this, I really wouldn't care. But you'll notice that one company owes, the subsidiary owes $20,000 in dividends. And so they have dividends payable of $20,000. Parent has dividends receivable of $14,000, to 70% of the 20. So can't owe yourself $14,000 in dividends. So that is going to be a credit to dividends receivable right here for 14, entry 6. It's 14,000, not 140, by the way. Let's make sure that's 14,000. To the two easiest entries. I got this, okay. And then we're going to have a debit to dividends payable for 14. So we've got the credit to dividends receivable for 14,000, entry 6. And finally, down here, entry 6, we're going to have a debit to dividends payable, 14,000. Okay, so we got all our entries in. You see that they total up to 824,000. That looks great on the sheet. And what we're going to do is just add across, see what we get. Sales is going to be 1,500 total. Income from sub is 60,000 minus 60,200, 60,000 minus 60,002, or plus, that gives you 0. That should always be 0. And on the equipment, on sale of equipment is 10. It comes from irrelevant information. Now, cost of goods sold should be 300,000, 400,000, 705,000 is what your cost of goods sold should be. So it's that plus that minus that, I believe, 705,000 negative. Good. Your depreciation expense will be the same thing, is equal to 155 negative 155 plus negative 50. Keep in mind these are expensive. Minus 9,000. That should equal 224,000. That looks correct. And then we're going to come to other expenses, which is usually a very easy entry. 300,000. Okay, and then we're just going to treat this as a negative because it's like an expense. We treat non-controlling interest net income as an expense here. And so if you add these things up, I'm going to include the 0, even though it doesn't matter. You come to, like I've been saying, the parent's net income of 255, 200. So the consolidated net income really is, I don't want to get into the presentation, but anyway, like I've been saying, the parent's income should be equal to the consolidated net income, and it looks like it does. Now we're going to bring down net income, and then just work across on the statement of retained earnings. This is 300,000, the parents. Now the subs retained earnings are 100,000 minus 100,000. Remember, for all you that need to view your debits and credits, debits to equity accounts, reduce them. Okay, then we come here down here to dividends, and this is going to be minus 200 plus a negative 500,000. We're going to add back 35 plus 15, so our dividends end up the same as the parent's dividends. So, like the simpler examples, it looks like the statement of retained earnings is exactly the same both for the parent. I'll bring this down here. Both for the parent, both on the parent's books and on the subs books. So if you look at the parents, 3 plus 255, 200,000. 200 minus 200,000 gives you 355.20, and the same numbers are on the statement of retained earnings. Now, those are ending retained earnings for the consolidation. We're going to bring them down to the consolidation worksheet. So we're going to bring those down. That's 355,200. Bring them down there. And we're going to finish the easiest statement, which is the balance sheet. Okay, so we're going to have cash of 96 plus 60 is 156. We're going to have accounts receivable of 100 plus 70 minus 10. It's going to give us 160. And we're going to have dividends receivable of 14. You got all zeros in it, doesn't matter. So minus 14 gives you 0, which means that the sub, you can't, if you're consolidating from, you're seen as one company and you can't owe yourself dividends. Then other current assets is, or inventories are 150 plus 100 plus 5,000 minus 5,000 because you wrote up inventory and wrote it all down. So you should come to 250,000, that 150 plus that 100. Other current assets, now these are going to be pretty easy. 100,000. Land, we didn't touch land. 150,000. We have buildings, which is 140 plus 160 plus the $14,000 write-up, but the excess plus the excess depreciation of 2,000 gives you 312,000 for buildings. For equipment, it's 570 plus 330 plus 210 minus the 7. You wrote them down. You wrote them by 21. Running off over 3 years at 7. So you should end up with 914. And then finally, that news notice came out there. The investment account. The investment account started at 512. You took 25 out, which gave you 490. That was a temporary thing. We did take out another 490, so the investment account is 515 200 minus 25 2 minus 490. The investment account is a big fat 0. It should always be. Goodwill is 60, and that stays on the books. Okay, and this unamortized excess, it's just nonsense. You don't have to worry about that. So let's see the sum of our total assets here. Looks like they did sum. We'll start with cash here. Sum down all the way through goodwill. End up with 2,102,000. It looks good. Now we've got the Liability to shareholders' equity, which usually are not too hard. Accounts payable is 200,000 plus 85 minus 10,000. You debit and credit fans, debits to liabilities reduce them. That gives you 275,000. And you've got 100,000 plus 20 minus 14. It's a liability. 106 for dividends payable. We've got other liabilities of 50 plus 95. So 145. Capital stock is 1 million plus half a million less half a million. That gives you 1 million, which is equal to the parents, by the way. We brought down retained earnings from above, which, by the way, is equal to parents' retained earnings. And finally, the balance, what we really did was we had an entry for 210. That was entry number 2, non-controlling interest. We had an entry to non-controlling interest at the end of the year to update it for 110,000. So to get our ending non-controlling interest, it gives us 220,800. Let's see if we sum here. We should. So we will start with accounts payable, and we will go all the way through non-controlling interest, and we balance 2102 and 2102. So we balance just fine. Notice that the non-controlling interest, basically we put in assets, all these assets, the subsidiary, are their 100% amounts. We wouldn't balance. You can't put 100% on the asset side, 70% on the equity side. So that 220,800 is basically the 30% to get us to balance. With adjustments thrown in, there's all sorts of adjustments thrown in there, but that's basic concept. Anyway, that's the consolidation. I will post this video, and I believe this will be an assignment. Probably your long assignment to date. You're going to have 2 problems like this, and then you're going to have a midterm, which is going to combine the 3 problems in a sense. It won't be hard, but it'll give you an idea of how to do this. And then we'll go on, finish the course with S aspects of consolidation and some pensions. Okay, so good accounting.